I've summed up my 10 takeaways and thoughts about this book in this video. I highly recommend you to read the original book of the author. 1. Dividend investing is a great way to build wealth over the long term, as it provides a steady stream of passive income. 2. Dividends are a portion of a company's profits that are paid out to shareholders, and they can be reinvested to buy more shares and increase future dividend payments. 3. Companies that consistently pay increasing dividends tend to be financially stable and profitable, making them good investments. 4. When evaluating dividend-paying stocks, it's important to consider metrics like dividend yield, payout ratio, and growth rate to determine which companies are most likely to continue paying dividends. 5. Diversification is important in dividend investing to spread out risk and avoid putting all your eggs in one basket. 6. Dividend investing is a long-term strategy that requires patience and discipline, as it may take time to see significant returns. 7. Investors should focus on high-quality dividend-paying stocks with a history of consistent and growing dividends, rather than chasing high dividend yields. 8. The power of compounding can significantly increase the value of dividend investments over time. 9. Dividend investing can be used as a tool for generating income in retirement, as it provides a consistent and reliable source of cash flow. 10. Successful dividend investors often follow a simple and disciplined approach to investing, focusing on fundamentals and staying patient and disciplined over the long term. Point 1 from Dividend Investing Made Easy highlights that dividend investing is a powerful way to build wealth over the long term. The book explains that this is because dividends provide a steady stream of passive income that can be reinvested to buy more shares of a company's stock. Over time, the compounding effect of reinvesting dividends can lead to significant growth in the value of an investment. Unlike other forms of investing, such as growth investing or trading, dividend investing offers a more stable and predictable way to build wealth. This is because dividend-paying companies tend to be financially stable and profitable, and their earnings provide a reliable source of income for shareholders. This income can be reinvested to buy more shares, leading to even more income in the future. Another advantage of dividend investing is that it can provide a cushion against market volatility. In times of market downturns or recessions, companies may cut their dividends or stop paying them altogether. However, many high-quality dividend-paying companies are able to maintain their dividends even in difficult economic conditions, providing investors with a more stable source of income during uncertain times. Overall, the book emphasizes that dividend investing is a powerful way to build wealth over the long term. While it may not provide the same short-term gains as other forms of investing, the steady stream of passive income that dividends provide can lead to significant growth in the value of an investment over time. Point 2 from Dividend Investing Made Easy explains that dividends are a portion of a company's profits that are paid out to shareholders. When a company makes a profit, it can choose to reinvest that money back into the business or distribute it to shareholders in the form of dividends. Dividends are typically paid out quarterly or annually, and the amount of the dividend is determined by the company's board of directors. Companies that pay regular dividends are often viewed as more financially stable and reliable than those that do not, as they are able to generate consistent profits over time. One of the key benefits of dividends is that they can be reinvested to buy more shares of a company's stock. This allows investors to benefit from the compounding effect of their investments, as each additional share they purchase increases their future dividend payments. Dividend investing is often compared to other forms of investing, such as growth investing, which focuses on companies that are expected to grow rapidly in the future. While growth stocks can offer significant short-term gains, they may not provide the same steady stream of income that dividend-paying stocks do. Dividend investing is therefore seen as a more conservative and predictable way to invest in the stock market. Overall, the book highlights that dividends are a key component of dividend investing, as they provide investors with a reliable source of income that can be reinvested to build wealth over the long term. By focusing on high-quality dividend-paying stocks with a history of consistent and growing dividends, investors can benefit from the compounding effect of their investments and build a successful dividend portfolio. Point 3 from Dividend Investing Made Easy explains that companies that consistently pay increasing dividends tend to be financially stable and profitable, making them good investments. A company's ability to pay consistent and growing dividends is a sign of its financial health and success. When evaluating dividend-paying stocks, investors should look for companies with a history of consistently increasing dividends over time. This indicates that the company has a stable business model and is able to generate consistent profits year after year. Companies that pay increasing dividends also tend to have strong cash flows and healthy balance sheets, which are important indicators of financial stability. Dividend investors often use a metric called the dividend payout ratio to evaluate companies. This ratio measures the percentage of a company's earnings that is paid out as dividends to shareholders. A lower payout ratio indicates that a company has more room to grow its dividend payments in the future, while a higher payout ratio may suggest that a company's dividend payments are less sustainable. In addition to the dividend payout ratio, investors should also consider the dividend yield and dividend growth rate when evaluating dividend-paying stocks. The dividend yield is the annual dividend payment divided by the stock price, while the dividend growth rate measures the percentage increase in dividend payments over time. Overall, the book emphasizes that investing in companies that pay consistent and increasing dividends is a smart way to build wealth over the long term. By focusing on financially stable and profitable companies, investors can benefit from the steady stream of income that dividends provide while also enjoying potential capital appreciation as the value of their investments grow over time. Point 4 from Dividend Investing Made Easy explains that when evaluating dividend-paying stocks, investors should consider metrics such as dividend yield, payout ratio, and growth rate to determine which companies are most likely to continue paying dividends. The dividend yield is the annual dividend payment divided by the stock price, expressed as a percentage. A higher dividend yield generally indicates that a company is paying out a larger portion of its earnings as dividends, but investors should be cautious of companies with excessively high yields, which may indicate that the stock price has fallen due to underlying problems with the company's business. The dividend payout ratio measures the percentage of a company's earnings that is paid out as dividends. A lower payout ratio generally indicates that a company has more room to increase its dividend payments in the future, as it is retaining more of its earnings to reinvest in the business. A higher payout ratio, on the other hand, may suggest that a company's dividend payments are less sustainable over the long term. The dividend growth rate measures the percentage increase in dividend payments over time. Companies that have a history of increasing their dividend payments consistently year after year are generally viewed as more stable and reliable than those that have more volatile dividend payments. In addition to these metrics, investors should also consider other factors such as the company's financial health, management team, competitive position in the market, and macroeconomic conditions when evaluating dividend-paying stocks. Overall, the book emphasizes that evaluating dividend-paying stocks requires a comprehensive and analytical approach, taking into account multiple metrics and factors to identify high-quality companies with a history of consistent and increasing dividend payments. By focusing on financially stable and profitable companies with strong fundamentals, investors can build a successful dividend portfolio that generates a reliable stream of income over the long term. Point 5 from Dividend Investing Made Easy explains that diversification is important in dividend investing to spread out risk and avoid putting all your eggs in one basket. By diversifying their portfolio, investors can reduce the impact of any one company's poor performance or dividend cut. This is because the negative impact of any one company's issues is offset by the positive performance of other companies in the portfolio. Diversification can be achieved in several ways. One approach is to invest in multiple companies across different sectors of the economy. By spreading out investments across industries such as healthcare, consumer goods, and technology, investors can reduce the impact of any one sector's underperformance. Another way to diversify is by investing in different types of dividend-paying stocks. This may include large-cap, mid-cap, and small-cap stocks, as well as domestic and international stocks. By diversifying across different types of companies and geographic regions, investors can reduce their exposure to any one company or country's economic performance. It's also important for investors to consider their personal risk tolerance and investment goals when diversifying their portfolio. Some investors may prefer a more conservative approach, focusing on high-quality dividend-paying stocks with a history of consistent and growing dividends. Others may be more willing to take on risk in search of higher returns, and may invest in more speculative dividend-paying stocks. Overall, the book emphasizes that diversification is a key component of successful dividend investing. By spreading out investments across multiple companies and sectors, investors can reduce the impact of any one company's poor performance or dividend cut, and build a more stable and reliable stream of income over the long term. Point 6 from Dividend Investing Made Easy highlights that dividend investing is a long-term strategy that requires patience and discipline. This is because it may take time to see significant returns and to build a diversified portfolio of high-quality dividend-paying stocks. While dividend investing can provide a steady stream of passive income over time, it's important for investors to keep a long-term perspective and avoid making impulsive decisions based on short-term market fluctuations. This may include resisting the urge to sell stocks during market downturns, or to chase after high-yielding stocks without thoroughly evaluating their fundamentals. Another important aspect of long-term dividend investing is reinvesting dividends. By reinvesting dividend payments back into the stock, investors can benefit from the compounding effect of their investments, leading to significant growth in the value of their portfolio over time. Discipline is also important in dividend investing, as it requires investors to stay focused on the fundamentals of dividend-paying stocks and avoid being swayed by market hype or speculation. This may include performing thorough research on companies before investing, analyzing key metrics such as dividend yield, payout ratio, and growth rate, and regularly reviewing and adjusting the portfolio to ensure it remains diversified and aligned with the investor's goals. Overall, the book emphasizes that successful dividend investing requires a patient and disciplined approach, focusing on long-term growth and income generation rather than short-term gains. By staying committed to the fundamentals of dividend investing and avoiding impulsive decisions, investors can build a successful dividend portfolio that provides a reliable source of income and long-term growth potential. Point 7 from Dividend Investing Made Easy emphasizes the importance of focusing on high-quality dividend-paying stocks with a history of consistent and growing dividends, rather than chasing high dividend yields. While high dividend yields may be attractive to investors seeking high income, they may also indicate that a company is struggling or that its dividend payments are not sustainable over the long term. A more reliable approach to dividend investing is to focus on financially stable and profitable companies that have a history of consistently paying and increasing dividends over time. To identify these high-quality companies, investors should consider metrics such as dividend yield, payout ratio, and growth rate, as well as the company's financial health, management team, competitive position in the market, and macroeconomic conditions. By conducting thorough research and analysis, investors can identify companies with a history of stable and reliable dividend payments that are likely to continue to generate income and provide long-term growth potential. Another important aspect of investing in high-quality dividend-paying stocks is diversification. By spreading investments across multiple companies and sectors, investors can reduce their exposure to any one company's poor performance or dividend cut, and build a more stable and reliable stream of income over the long term. Overall, the book emphasizes that focusing on high-quality dividend-paying stocks is a more reliable and consistent approach to dividend investing than simply chasing high dividend yields. By conducting thorough research and analysis, and diversifying their portfolio, investors can build a successful dividend portfolio that provides a reliable source of income and long-term growth potential. Point 8 from Dividend Investing Made Easy highlights the power of compounding in dividend investing, which can significantly increase the value of investments over time. Compounding is the process of reinvesting earnings or income back into an investment to generate even more earnings or income. In the case of dividend investing, this means reinvesting dividend payments back into the stock to buy more shares, which in turn leads to even higher future dividend payments. Over time, the compounding effect of reinvesting dividends can lead to significant growth in the value of an investment. This is because each additional share purchased with reinvested dividends increases the future dividend payments, leading to even more shares purchased with those dividends, and so on. The power of compounding is particularly evident over long periods of time. As the number of shares purchased with reinvested dividends grows, the amount of dividend income generated by the investment also grows. This can lead to significant growth in the value of the investment, even if the stock price remains relatively stable. Overall, the book emphasizes that the power of compounding is a key advantage of dividend investing, and can significantly increase the value of investments over the long term. By reinvesting dividends back into the stock to buy more shares, investors can benefit from the compounding effect of their investments and build a successful dividend portfolio that generates a reliable stream of income and long-term growth potential. Point 9 from Dividend Investing Made Easy highlights that dividend investing can be used as a tool for generating income in retirement, as it provides a consistent and reliable source of cash flow. Many retirees rely on investment income to supplement their retirement savings and maintain their standard of living. Dividend investing can be a particularly attractive option for retirees, as it provides a steady stream of passive income that can be used to cover living expenses or reinvested to provide additional income in the future. Retirees may also benefit from the stability and predictability of dividend-paying stocks, as they tend to be more resistant to market volatility and economic downturns than other types of investments. This can provide a sense of security for retirees who are relying on their investments to provide income. When investing for income in retirement, it's important for retirees to consider their overall financial goals, risk tolerance, and income needs. By building a diversified portfolio of high-quality dividend-paying stocks, retirees can generate a reliable stream of income while also enjoying potential capital appreciation as the value of their investments grow over time. Overall, the book emphasizes that dividend investing can be a powerful tool for generating income in retirement. By building a well-diversified portfolio of high-quality dividend-paying stocks, retirees can benefit from a steady stream of passive income that can be used to support their retirement lifestyle and provide long-term financial security. Point 10 from Dividend Investing Made Easy highlights that dividend investing can be a simple and accessible investment strategy that anyone can use to build wealth over time. Unlike other forms of investing that require specialized knowledge or skills, dividend investing is a straightforward approach that involves investing in high-quality dividend-paying stocks over the long term. While there are certainly nuances and complexities to successful dividend investing, the basic principles can be understood and applied by investors of all levels of experience and expertise. In addition, dividend investing can be a cost-effective way to invest in the stock market, as it involves buying and holding stocks over the long term rather than actively trading or timing the market. This can reduce transaction costs and other fees associated with more active forms of investing. Another advantage of dividend investing is that it can be tailored to an investor's individual needs and goals. Whether an investor is looking to generate income, build wealth over the long term, or supplement their retirement savings, dividend investing can be used to achieve a wide range of financial objectives. Overall, the book emphasizes that dividend investing can be a simple, accessible, and cost-effective way to build wealth over time. By focusing on high-quality dividend-paying stocks and using a patient and disciplined approach, investors can generate a reliable stream of passive income and long-term growth potential that can help them achieve their financial goals. Thank you for your interest in this book. Please leave your feedback on these thoughts in the comments below, or just put a like on this video. It will help me stay motivated and make more videos like this. In the description of this video, you may find links where you can purchase this book.